7 ways to handle a stock market decline. That's what we're going to talk about here today at the Heritage Wealth Planning YouTube channel. Pretty important stuff as we just went through a bear market, our first real live bear market, at least in large cap domestic stocks since 2009. So we're out of it now. We're back into, I think we got beyond correction territory. Maybe it's a dead cat bounce. I don't know, but remains to be seen. There will be others to come. So we're going to talk about 7 different ways, what you need to know in order to handle one for sure. So let's dive right into this, my friends. As always, you like what you see here, subscribe down below. And of course, thumbs up, comments always help. All right, so this is from American Funds, and you know that that's a weird picture to start the article, how to handle market declines. And you know I'm a big fan of American Funds. They've been around for a long, long, long time, and I just think they're a fantastic fund company. They do charge a commission, and a lot of people, commissions. If you look at the performance of their funds, even with commission, it's phenomenal, without question. So hard to go wrong with American Funds, Vanguard, and USAA. But my problem with USAA is I just don't know where they are anymore because they sold investment management company, and I don't know what's that's going to mean in the future. So hard to go bad with American Funds and Vanguard as we see here today. All right, 7 ways to fight fear with facts. Nobel Prize. You wouldn't be human if you didn't fear loss. 100% agree. Prize-winning psychologist Daniel Kahneman demonstrated this with his loss aversion theory, showing that people feel the pain of losing money more than they enjoy the gains of making it. And I have his book in here someplace. Might be behind me there. Hold on just a second. Yeah, right here. All right, so good. If you're looking for a good book to read, this might be it. Thinking Fast and Slow by Daniel Kahneman. He is a Nobel Prize winner, and I don't think Tversky was part of this, was he? Even though it's a funny thing, yeah, he's a Nobel Prize winner in economics, even though he's not an economist by trade. Very interesting. He received the Nobel Prize for his pioneering work with Amos Tversky on decision making. He received it in 2002. And yet Tversky wasn't part of that Nobel Prize. I think Tversky had died by then, actually. I think one of the things to be a Nobel Prize winner, you have to be alive. Anyway, so as such, an investor's natural instinct is to flee the market when it starts to plummet, just as greed prompts us to jump back in when stocks are skyrocketing. Both can have negative impacts. But smart investing can overcome the power of emotion by focusing on research. All right, so number 1. Market declines are part of investing. Stocks have risen steadily for nearly a decade. Now, this article was written back in November 2018. Yeah, so right before, it was during when we were getting hammered around a little bit. But history tells us that stock market declines are an inevitable part of investing. The good news that is corrections defined as 10% or more decline, bear markets, which are 20% or more, and other challenging patches haven't lasted forever. And here we're talking about the Dow going from 1900 to 2017. And we talk 5% or more happens about 3 times a year. So the market goes down 5% or more about 3 times a year, and it averages 46 days in length. 10% or more happens about once a year, and it averages 115 days. 15% or more happens about every 2 years, and it stays for about 216 days. And the big one, this is what I always talk about, a bear market, 20% or more happens about once every 3.75 years. So basically once every 4 years, and it lasts for about a year. You got to keep that in mind. That's the Dow, and the S&P is going to be similar. And so that's and then what is it where it's no longer considered the bear market? They say assumes a 50% recovery of lost value. That's where you're saying the average length, the average frequency, and then measures market high to market low. So again, a 5% or more loss happens 3 times a year on average, which is pretty nuts actually. The Dow Jones average has typically dipped at least 10% about once every year, and we already talked about that. While past results are not predictive of future results, each downturn has been followed by recovery and a new market high. That's if you did not think that, you should not be investing. There's just no other way around that, my friends. If you think this time it will not come back, you need to get out. That's all there is to it. Because the only way you stay in the investment market if you think it's going to come back. If it's not coming back for whatever reason, then you don't. Why would you even get back in? Doesn't make sense. Time in the market matters, not market timing. I cannot agree with it. This is probably my one fundamental thing you can take away. No one can accurately predict short-term market moves, and investors who sit on the sidelines risk losing out on periods of meaningful price appreciation. Every Standard & Poor's decline of 15% or more from 1929 to through 2017 has been followed by a recovery. Every single one. The average return in the first year after each of these market declines was nearly 55%. So let me say that again. Every decline of 15% or more in the S&P 500 has been followed by a recovery, which was averaged nearly 55% in the first year after that decline of 15% or more. That's nuts. Now, will that happen again? No idea. And that's why it comes to faith. If you do not believe the markets will recover, then get out. It's okay. Even missing out on just a few trading days can take a toll. A hypothetical $10,000 invested in the S&P 500 made in 2002, the start of the recovery following the bursting of the tech bubble, would have grown to more than $18,000 by the end of 2012. But an investor had to miss the 10 best trading days during that period. He would have ended up with just $9,000, which is less than the initial investment. So here you go. You missed the top here. If you stayed invested the whole time, you're $10,000, and this is after even with 2007 through 2009, you're up to $18,000 over that 10-year time. You miss the 10 best days. Your $10,000, you are left with $9,300. That is crazy. You miss the best 20 days. Your $10,000 are left with $6,000. Now, that does exclude dividends. Now, even in this case, the dividends aren't huge, 2% a year. So it would be a little bit less brutal, but you're probably breaking even. I've missed the 10 best days if you factor in dividends. I don't know, it'd be close. But still, if you are in the market, you've got to stay in there. You cannot get out and get back in. No one can. You don't know when it's going to happen. You missed the 5 best days. Your $10,000 went from $10,000 to $12,000. You might as well just be in CDs, for heaven's sake. Emotional investing can be hazardous. And going back to Kahneman, and I'll put a link in the show notes to his book. And if you want to buy it, I'll get a commission off that. And this is the hardback. Who's a $30 is when I bought that. I'm sure I didn't buy it for $30. But anyway, I'll put a link in the show notes because Kahneman's very his stuff is actually, when you think about it, it's not revolutionary other than no one did it up until him, which is pretty amazing. For his work in behavioral economics, a field that investigates how individuals make financial decisions. A key finding of behavioral economists is that people often act irrationally. Emotional reactions to market events are perfectly normal. Investors should expect to feel nervous when the markets decline, but it's the actions taken during such periods that can mean the difference between investment success and shortfall. So basically selling when the market is low and buying when the market is high. Make a plan and stick to it. Creating and adhering to a thoughtfully constructed investment plan is another way to avoiding making short-term investment decisions, particularly when markets move lower. No one ever does anything when markets going higher, other than I should have been over there instead of over here, but it's always when the markets are low. The plan should take into account a number of factors, including risk tolerance and short and long-term goals. One way to avoid futile attempts is to time the market is with dollar cost average. I'm just not going to get into all that. The dollar cost averaging, I'm a big fan of. That just means putting $100 a month into an account. I agree with that if you're investing for accumulation, for sure. But if you're out of the market and you're saying I'm going to get back in now, and you just want to avoid a huge hit to your money, dollar cost averaging, we're just dumping in a certain amount every month or every year or something like that makes sense. But I don't like that unless I'm saving through a 401k or something like that. I just think if you're going to be in the market, get all in. Absolutely. Keep enough on the side to avoid any up and down in terms of what cash flow you need. But if you're going to be in the market, get in there because, again, going back to this right here, if you miss just 10 days of the 2002 to 2012, you lost money. So don't dollar cost average if you're sitting on the side. Just go all in there and be done with it. And say, I'm not going to look at the accounts. I'm not going to check my phone. I don't care. Unless you need the cash, that's different. If you need the cash, well, you should have the 2 or 3 years of savings set on the side for sure. Diversification matters. I do like this one quite a bit. Here's you got the black is cash. And as you can see, cash has been all over the board. This from 2008 to 2017. Emerging markets were number one for 3 of those 10 years. Large cap stocks were number one for 4 of those 10 years. Bonds were number one for 2 of those 10 years. And then global small cap stocks were number one for 1. But the irony of it all is, look, emerging markets were up, and they're in the top. Let's see, the number 1 or 2 for 1, 2, 3, 4 of those 10 years, and they were in the bottom 1, 2, 3, 4, or the top, the bottom 4, but also the bottom, the 2 worst were 5. So of the 10 years, they're either the best or the worst. Basically, there's no middle of the road for emerging markets, which is kind of funny. So did great. You did horrible in 2008. You did great in 2009. Did pretty good again in 2010. And then they got crushed in 2011. When do you think people were buying it? Probably right here in 2010. Then they got crushed. They sold probably in 2011, which they sold when it did great in 2012. So they got back in 2012. They got crushed. Got crushed. So 3 years of getting crushed. They're down 2.6, 2.119, 14.92. What do you think they did? They didn't buy, and then they missed pretty good gains, and the number 1 was in 2017. I just always chuckle at that. Without question. Now, here's large cap stocks in the middle, right there in the middle, a couple years on the top. What would that tell you you think it would be for the next 4 or 5 years, given that they're middling, and then on top, probably that they're going to be more down here, I think, but who knows? Fixed income can help bring balance. Now, I'm not a big fan of bonds generally, but after looking at the Wellington Fund, it absolutely brings balance without question. I mean, there's no getting around that. I don't think you buy bonds for growth. In fact, you should not buy bonds for growth. That'd be silly. But if you are going to buy bonds, or if you are worried about the markets for volatility, the bonds can be your friend. It's not going to help juice your portfolio, but it certainly can at least eliminate some of the downside. And Wellington's a perfect example of that. Stocks are important building blocks of a diversified portfolio, but bonds can provide an essential counterbalance. That's because bonds typically have low correlation to the stock market. Well, they did other than 2008, when the only thing that had any kind of no correlation in the market was government bonds. And so here you go. They're talking about what's this? So the bonds will tend to go flat when the market zigs and zags here. Here's the S&P, April 2010 to July of 2010, getting crushed, and the bond index was up 3%. Here's the S&P in 2011 getting crushed, and the bonds are up 5%. Here's the S&P in 2015 to getting crushed. The bonds were just breaking even, the same thing. So that does give us some stability, and avoiding a loss is a pretty big deal. Actually, the irony of it all is we have not had any bear markets since 2009, but we've had a bunch of corrections, 12%, 18%, 16%. What's more, bonds with a low equity correlation can offer protection from losses even while the broader market is in turmoil. And again, the Wellington Fund is a perfect example of that for sure. The market tends to reward long-term investors. I completely agree with this. Let's see, when stocks are falling, it's important to maintain a long-term perspective. Although stocks rise and fall in the short term, they tended to reward investors who invest are long-term, even including downturns. The S&P's 500's mean return over all 10-year periods was 10.43%. So we got some serious ups and downs, and yet the average return of the S&P 500 was roughly 10.5%, even though look at that. Here's the mean right here, 10.5%. That's the average. All right, here's and look at that. And we got down, these are the up 20, down 5, breaking even, up 5. Just hardly ever does it break into the mean. And I use that Vanguard study a lot to show that, as a matter of fact. So it's just nuts. We got significant returns variation, but on average, it's been about 10.5. I don't think that's going to happen going forward. I'm looking at about 7.5 to 8, but there you have it. 7 things to do to avoid a market, to handle a market decline, or 7 ways to fight a market decline. Just keep your eyes on the road. Keep steady, and frankly, don't pay any attention. If you got enough money in cash, who cares what the market does? So really, who cares? And lastly, if you are concerned that the market is this time going to go bankrupt, then get out. It doesn't make sense. It's okay to buy a CD. As always, hope you like what you see. Don't forget to subscribe, thumbs up, comments. Love to hear your thoughts on this. And again, American Funds has wonderful stuff here. And you should look at AmericanFunds.com, capitalideas.com. All right. See you guys next time. Thanks, Dan.